So it's early February 2026. The days are finally getting a little bit longer. And if we stick to the traditional script, the London property market is supposed to be waking up right about now. But looking at this stack of sources you've sent over for our deep dive, well, the last few years haven't exactly followed that script, have they?
No, they really, really haven't. I mean, if you look at this fresh analysis from Bluestone Properties and then cross-reference it with broader data from heavyweights like Winkworth,
Yeah.
the market's been, well, incredibly disjointed.
Disjointed is a mild way to put it.
We actually saw transaction levels dip to their lowest point in over 2 decades.
Wow. Okay, that sets a pretty grim stage. So the mission for today is to figure out if that paralysis is actually over. Is this spring bounce for real? Or is it just, industry optimism?
Well, the headline they're using is recalibration.
Recalibration. To me, that sounds a little bit like corporate jargon for still disappointing. What does that actually mean on the ground?
It's less about disappointment and more about sanity returning. The data suggests we aren't heading for a chaotic boom, which, is what we saw back in 2021, but the ice is definitely thawing.
The ice is thawing.
Yeah, that massive staring contest between buyers who couldn't make the math work and sellers who just refused to drop their prices.
Oh.
It's finally breaking.
Okay, but what broke it? I mean, interest rates haven't hit the floor, and let's be honest, London property isn't exactly cheap. So why is the confidence coming back now?
Because the math has changed in a really fundamental way.
How so?
There's one metric in this report that really, really stands out. For the first time in a long while, wage growth is currently outpacing house price rises.
Wait, really? That feels like a stat we haven't heard in maybe a decade. Usually it's the other way around.
It is rare, but that crossover point is just vital because it means real-term affordability is finally starting to catch up. And when you combine that with the slight dip in mortgage rates we've seen and, a clearer fiscal policy after the autumn budget, well, the people who are sitting on the sidelines are running out of reasons to wait.
So people actually have the capacity to buy again. But let's look at the forecast numbers. The report's predicting growth of around, 2 to 4% across Greater London for spring 2026?
That's right.
I have to play devil's advocate here. Compared to other investments or even just inflation, that sounds incredibly underwhelming.
It sounds boring, doesn't it?
Yeah.
But in the property market context, boring is actually beautiful right now.
How is boring beautiful? Usually everyone wants those double-digit returns.
Not if you want a market that actually works. Think about it. If prices are spiking 10% a year, sellers hold off, hoping for more, and buyers panic buy.
Because they're scared of being priced out.
Exactly. It creates all this volatility. A 2 to 4% rise is sort of the Goldilocks zone. It's enough to encourage sellers to list their homes without triggering a bidding war that just scares everyone off. It means liquidity.
It means you can actually trade.
You can actually trade.
So stability lets you plan a life rather than just, gamble on an asset.
Yeah.
But I see a counterpoint here in the data regarding supply. If everyone decides boring is good and starts moving, don't we just run into a brick wall?
We do, and that is the structural floor under these prices. We simply aren't building enough new homes, particularly near major transport hubs. So even with modest growth, that scarcity of quality stock keeps prices from sliding backward.
Right. Which brings us to the where. If supply is tight and affordability is still a constraint, even with that wage growth, where is all this money going?
The report mentions an urban village effect. Is that just a fancy way of saying people are forced to move further out? It's a little more nuanced than that. It's not just about fleeing the center because it's expensive. It's a very specific trade-off that people are making. Buyers are willingly sacrificing the prestige of, say, a zone 1 or 2 postcode to get livability.
Livability is a broad term. What are they actually buying?
They're buying the green space, the genuine community high street, the extra square footage. They want that village feel, but still within the London orbit.
Okay.
And the data shows that outer boroughs offering that specific lifestyle mix are seeing more activity than some of the traditional prime central areas. It's a value realignment.
So it's less about central or bust and more about lifestyle per pound.
That's the driver. And for you listening, that's really the strategic angle here. If you're looking to buy, the opportunity right now isn't in chasing the hottest postcode. It's in identifying those areas that offer that village stability before they re-rate upwards.
It really seems like the theme for spring 2026 is just balance, modest growth, functional trading, and sensible geography.
It's a return to fundamentals, a return to sanity, really.
Okay, before we wrap up, here's a thought to chew on. If this urban village trend is structural, and it seems like it is, driven by lifestyle and limited central supply, are we watching the very definition of prime London actually expand? Something to consider while you scroll through the listings. Thanks for listening to this deep dive.